this credit bubble is here, and it's being manifested right now in these very sophisticated parts of the market. And eventually they'll ripple to the broader economy at large. But how a person feels this is they're not going to be able to get a car loan or a mortgage, or the interest rates they pay will go up. And then how bondholders will react to all of this stuff is they'll just start to find different assets, probably the front end of the curve, money market, cash, gold, and they'll just abandon all these assets. And then the other problem is that it's just really, really bad for risk assets. So the things that we invest in,
startups, technology companies,
either in a world of inflation run amok because the Fed isn't hiking fast enough, which just destroys future cash flows, or in a world where the Fed pivots in a moment like this, and Nick, you can show the second chart, both result in the same outcome, which is that you just see these massive drawdowns in the value of risk assets. So we're in a really complicated moment. And this is why I think, again, the Fed needed to take leadership this past week and actually do the hard work of either cutting 50 bips or raising 50 bips. And this middle path is the absolute worst path, because trying to thread a needle in this complicated economy, I think, is just going to be impossible. And then what happens is then the markets move around them, right? The markets have completely said, we now discredit what you did. And they're basically banking that the Fed will be forced to cut rates massively in short course, because the crisis will be so severe that it'll outweigh the risk of inflation. Think about that.
Yeah. So all of this real estate comes on the market. There's no buyers for it. The mortgages are due. Does that mean a commercial real estate owner just basically gets foreclosed on and they hand the keys back to the bank? Or are the banks, as this Wall Street Journal story was sort of alluding to, that the Fed will say, you know what, we'll just extend, we'll backstop this real estate, which happened in the last bubble, and we hope that over time it works itself out and demand returns. Now, of course, that's different than a post-COVID world, so this time could be different. What happens in the case of 2024, 2025, all of these office spaces are returned and the keys are handed back?
Yeah. So, okay. So Jason, you asked a question like, how does this problem manifest? Let me describe it from the point of view of that real estate owner. There's basically two problems. One is that you have a tenant who's in a long-term lease, 5, 7, 10 years. That lease rolls. So that lease comes due. Now they don't need the space anymore. You know, we know that, take San Francisco, which has got to be the worst market for CRE in the country right now, that something like 30 to 40% of the space is vacant. So that's either space for rent or space for sublease because no one's using it. So they put it back on the market. Well, all those subleases, they're still paying rent because they have a contract. So what happens is, as those leases roll, now all of a sudden you don't have to pay rent anymore, so you're going to stop. Or if you still need the space, you're going to negotiate a much, much lower rent. So now all of a sudden, the real estate owner can't make their debt service covenant ratios. The income from the building is just substantially less. They can't make their debt service.
Let's pause on that and explain that ratio to folks. You have a certain amount of debt you own, let's say Salesforce Tower. In Salesforce's case, they're subleasing 125,000 square feet. Let's say they were into that for $500 million. What is this debt service ratio? Explain that to the audience.
When the bank underwrites the loan, they just figure out the interest that you got to pay on the loan relative to the value of the building or the income that it's generating. But all those ratios are upside down now because the value of the buildings, the rent, has gone down so much because there's so much vacancy. I mean, when these loans were underwritten, San Francisco had like a 5% vacancy rate. And now it's like 30 to 40%. There are just no tenants. And then, you know, in parallel with that, Jason, you've got all these cases where you not only have tenants or leases rolling, you have loans rolling. You know, again, if the owner of the building has either a construction loan or like a long-term debt and that needs to roll, they have to refinance it. And if they can even get credit, which they may not be able to because of this crunch, they're going to be paying a lot more for it. So now all of a sudden, the income statement for that building doesn't make sense. Think about it. Your borrowing costs are higher and your revenue is lower. So now all of a sudden, the building's underwater. So where does that end up? Well, they default on the debt. and the bank ends up owning the building. So then what happens is you end up with, all of downtown San Francisco owned by a bunch of banks. What are they going to do with it? They don't want to be in the real estate business. So they have to fire sale those buildings in a bunch of auctions at rock bottom prices because, by the way, there's no cash or liquidity out there. So who are the buyers?
Who's the buyer?
Be?
That was
nobody.
Exactly
There are no buyers. We have a 30% vacancy rate. There's no renters. So
what happens? Detroit, is it just like a dead city?
And then the tax base collapses the city because so much of the tax base is dependent on, real estate. So listen, I think they're going to have to work this out. I don't think they can just let the free market take its course here because you're going to end up with the scenario I just painted. So I think what hopefully would happen maybe is that the banks do some sort of deal with the real estate owners that, they blend and extend or whatever. But in order to do that, they're going to need to be backstopped by somebody. And that's the Fed.
Freeberg, what are your thoughts? Just writ large, as it were, on the commercial real estate space, because it's $90. It was $90 a square foot, right, for Class A Saks in the city? Was that the price?
I mean,
what's that going to be?
60, 70, 80, $90 a foot, depending on what kind of building you're talking about. I mean, You have all these empty office towers. So look, I never invest in office towers. I do small boutique kind of brick and timber spaces in Jackson Square. We're doing okay because people still want to be in those spaces. But these office towers on Market Street or in Soma, which is where all the investment went during the boom. Nobody wants to be in those buildings anymore. And it doesn't help that the city has allowed this giant, open air drug market to metastasize right outside their door.
Freeberg?
Yeah, I think it's inevitable. We'll have probably $2 to $3 trillion of federal money, spent to backstop and support the asset. That's the general theme here, in case everyone isn't paying attention at home, is that the Fed, the U.S. government, will continue to print money and create programs to effectively support asset values such that there isn't a crippling economic ripple effect. And this is the dangerous debt spiral of debt. And it's why I always talk about how concerned I am about global debt levels, and particularly debt levels in the U.S., but really global debt levels. I'll say the statistic again and over again, 360% global debt to global GDP. But, even within some of these asset classes, a significant amount of debt has been used to fuel asset prices and to fuel equity value. And then that equity value gets levered and reinvested. And so the rippling effect in the economy of declining asset value can be magnified through leverage. And unfortunately, debt in general forces growth. Without growth, debt fails. And so when we've used debt to demand growth on a macro perspective, it causes, significant stress and strain on the system when you're going through periods of like we are right now, what should be natural recessionary effects from COVID and shutting down the economy, or natural asset price declines because of that. And we can't let it happen, because if it were to happen, the rippling effect would be crippling. So this is a good example. You'll probably, I don't know what the facility will look like. Maybe the government passes some congressional bill that says, hey guys, here's $3 trillion to support, all this real estate. Here's another, $2 trillion to support banks and, giving them liquidity. Because the other problem, as you guys know, is most of the population in the US has most of their assets, their asset value or their equity value in their home. And those home prices are supported by residential loan programs. And, if you actually have a massive write down of the value of that asset class, that's when, everything kind of falls apart. So, we will continue to be buoyed by that kind of inflationary behavior. Unfortunately, Balaji, I think, has it right. We'll talk about his debt in a minute, that there has to be money printing to get out of this hole. I don't know if it's necessarily in this moment hyperinflationary, as he predicts. He uses the Deutschmark and the Weimar Republic as this kind of storyline that this is what's about to happen in the US. The truth is, it looks a little bit more like the pound sterling at the end of the British Empire, where, there's certainly an inflationary and devaluation effect that arises, but it is the reserve currency of the world today. And so it's really hard to kind of just say, hey, it's going to be hyperinflationary and the value is going to go to zero. It's just not going to happen.